Imagine having a powerful tool to potentially protect your money from the ups and downs of inflation, or to add unique diversification to your investment portfolio. Many people think of gold bars or barrels of oil when they consider commodity investments, but there is a much more accessible way to participate in these markets. And the good news is, yes, you absolutely can invest in commodities using mutual funds. These funds offer a convenient and often diversified approach to gaining exposure to raw materials like energy, metals, and agricultural products, without having to buy physical goods or navigate complex futures markets directly. The key to understanding how mutual funds invest in commodities lies in their structure. Most commodity mutual funds do not hold physical commodities themselves. Instead, they typically gain exposure through financial instruments such as futures contracts. A futures contract is an agreement to buy or sell a specific quantity of a commodity at a predetermined price on a future date. By investing in these contracts, the fund aims to capture the price movements of the underlying commodities. Additionally, some mutual funds, called natural resource funds, invest directly in the stocks of companies that are heavily involved in commodity production, such as mining companies or oil and gas producers. This gives investors an indirect stake in the commodity market through equity ownership. To find these types of funds, you will typically look for those categorized as commodity funds, natural resource funds, or managed futures funds. It is important to carefully review a fund's prospectus, which is its detailed operating document. This document will explain the fund's specific investment strategy, how it gains commodity exposure, and its associated fees, known as expense ratios. Always prioritize understanding what a fund actually invests in before making a decision. A significant benefit of commodity mutual funds is the potential for portfolio diversification. Because commodity prices often move differently than stock and bond prices, adding commodities can help smooth out overall portfolio returns during various market cycles. This is particularly true during periods of inflation, where commodities can sometimes act as a valuable hedge. Furthermore, many commodity mutual funds are actively managed by professionals who make decisions about which commodities or contracts to invest in, aiming to optimize returns for their shareholders, though this also comes with management fees. So, by choosing a commodity mutual fund, you are leveraging professional management and diversification to potentially enhance your investment strategy, all within the familiar framework of a mutual fund. This approach allows everyday investors to access the commodity markets, aiming for inflation protection and portfolio stability, without the complexities of direct commodity trading.